Welcome back to the deep dive. Today, we're going to play a little game right off the bat.
Oh, all right. I'm ready.
So I want you to just look around the room you're sitting in right now. Or, if you're driving, look at the dashboard, look at your smartphone,
Wow.
look at the cereal box sitting on your kitchen counter.
Okay, looking at my phone.
There is a remarkably high probability that one specific company, a company that most people have literally never heard of, helped build almost every single one of those things.
It is the ultimate hidden giant scenario.
Exactly. We are talking about the Nordson Corporation, ticker symbol NDSN. They are basically the invisible backbone of the entire manufacturing world. And we aren't just bringing them up today because they make cool stuff.
Right.
We're digging into them because of the date. It's February 19th, 2026, and they just dropped their earnings report for the first quarter of fiscal year 2026.
Which came out yesterday, yeah. And this report is, honestly, it's fascinating. You don't just read it as the balance sheet. It is essentially a weather report for the global economy.
That is a really great way to frame it, because Nordson sits at this incredibly weird but perfect intersection. They're doing heavy industry, they're deeply involved in medical devices, and they are right at the absolute cutting edge of semiconductor tech.
Yep.
So if you want to know what's actually happening with the AI boom, or if you want to know if global factories are humming or stalling, you look at Nordson.
Yeah, the bellwether.
And the headline from this specific Q1 report is extremely loud. It was a record-breaking first quarter.
Let's get right into those numbers then.
Okay.
Because they're big, but they're also a little bit complex. The headline sales figure was $669 million for the quarter.
Right.
And that is up 9% compared to the exact same time last year.
Which, on the surface, sounds fantastic. A 9% jump for an old-school industrial company is nothing to sneeze at.
It's solid.
Yeah.
But we're here to peel back the layers on that, right? Because we
Yeah.
know in this economy, top-line growth can sometimes be a bit of a mirage.
Oh, absolutely. It can be inflation, it can be currency manipulation. So was this real growth? Or was it just accounting magic?
It was mostly real.
Yeah.
But they did get a little help from the currency markets. So if you break down that 9% jump, about 4% of it came from favorable foreign exchange rates, FX.
Okay.
The dollar weakened a bit against some key global currencies. And when that happens, it makes their overseas sales look much bigger when they convert them back to dollars for the earnings report.
Got it. So almost half of that headline growth was literally just math.
Almost half, yeah. But the other part, the organic growth, as they call it, was 7%, meaning they physically sold 7% more actual stuff than they did last year.
Wait, 7 plus 4 is 11. How do we get back to 9%?
Ah, right. Good catch.
Yeah.
You have to remember they actually sold off a business unit last year as a medical contract manufacturing arm.
Oh.
So that divestiture created a drag on the year-over-year comparison. When you strip out the currency help and you account for the business they literally don't own anymore, the core engine of the company is running hot at that 7% organic mark.
And are they actually making money on all this extra activity?
They certainly are. Adjusted earnings per share, EPS, hit a record $2.37. That's up 15% from last year. So it's a very clean beat on both the top line and the bottom line.
Now, I do have to ask you about this one thing I saw buried in the footnotes.
Let's hear it.
Because usually when we look at these earnings, the adjusted number is higher than the GAAP number, the official accounting number.
Right. Companies love to add back expenses to make themselves look more profitable.
Exactly. Exclude these one-time costs and suddenly we look great. But here, it was the exact opposite. The official GAAP earnings were actually higher than the adjusted number. That almost never happens. What's going on there?
This is such a great little nugget in the report. It turns out Nordson isn't just a manufacturing company. They play venture capitalist on the side sometimes.
Well.
Yeah. Years ago, they made this minority investment in a tech company. Well, fast forward to December 2025, right in the middle of this quarter, and that company had an IPO on the Korean Stock Exchange.
No way. They cashed in on an IPO.
They absolutely did. Nordson booked a non-cash gain of about $22 million just from that IPO.
That is a very nice little bonus check.
It is. But because that $22 million didn't come from, selling glue dispensers or x-ray machines, they responsibly stripped it out of their adjusted earnings.
That makes sense.
They wanted to show investors, look, here is what our actual business operations did, completely separate from our lucky stock investment.
And the fact that they still hit a record EPS without relying on that IPO money really speaks volumes.
It shows total operational strength and real discipline from management.
I love that. But let's move to the main event here. because we definitely didn't pick this deep dive just to talk about accounting adjustments and currency exchange.
No, we did not.
We picked it because one specific part of Nordson's business is just absolutely exploding right now, and it really tells us everything we need to know about the current state of the tech world.
You're talking about the ATS segments.
Advanced Technology Solutions, yes.
Yeah.
This is the part of the company that serves the electronics and semiconductor markets. And the numbers here were just silly. Sales were up 23% year over year. Organic growth was up 21%.
It is the star player of the quarter, without a doubt. And management was extremely clear on the call about what is driving this train. It is semiconductor applications. That one specific slice now accounts for roughly 50% of this entire segment's revenue.
And the key word behind all of that is AI.
It's entirely AI. But we need to be really specific here for the listener. We aren't talking about software. We aren't talking about ChatGPT writing a poem.
Right.
We are talking about the massive physical hardware required to run those AI models. And this is exactly where Nordson's unique expertise comes in. It revolves around a concept called advanced packaging.
Advanced packaging, which honestly sounds like they're putting computer chips in a really premium cardboard box with a nice bow.
I know, it's a terrible name for incredibly cool tech. Think about the history of computer chips. For decades, the goal was just to make the chip smaller, shrink the transistors.
Moore's Law.
Exactly, Moore's Law. But we've essentially hit a wall with physics. We literally cannot make them much smaller on a flat, two-dimensional surface anymore.
So if you can't build outward, you have to build upward.
That's it. Just like a skyscraper in Manhattan, if you run out of land, you build vertically. So what chip makers are doing now is taking logic chips, the brains of the operation, and memory chips, and literally stacking them on top of each other.
Okay.
The industry calls it heterogeneous integration, but honestly, let's just call it stacking silicon pancakes.
Stacking silicon pancakes. I like that. So we have this highly expensive stack of pancakes. Where does a company like Nordson fit into this?
Well, silicon is incredibly fragile, and these AI chips generate an unbelievable amount of heat. If you just stack them up dry, the heat would warp them instantly, or the tiny vibrations would just shake them apart. You need intense structural integrity.
Right.
So you need to fill the microscopic gaps between those pancakes with a highly specialized material.
High-tech glue.
Basically, yes. The industry term is underfill. And this is the market Nordson dominates. They build the machines, specifically the Vantage and the Spectrum S2 systems, that inject this fluid into gaps that are just microns wide.
Wow.
And they have to do it fast for mass production, and they have to do it absolutely perfectly.
Why perfectly? I mean, what happens if there's a tiny air bubble in the glue?
If you get an air bubble, what they call a void, it acts as an insulator. It creates a hot spot. The heat can't escape through the bubble, so the chip overheats and the entire stack fails.
Ouch.
And remember, we are not talking about a $5 chip for a microwave anymore. A full stack of AI GPUs and high bandwidth memory can cost tens of thousands of dollars.
For one unit.
For one unit.
Yeah.
So if Nordson's machine messes up the dispensing and leaves an air bubble, you have just thrown a luxury car's worth of silicon straight into the trash.
So the stakes are just incredibly high for the manufacturers.
Beyond high. That is exactly why manufacturers are willing to pay top dollar for Nordson's precision equipment. They are buying reliability. And that's why you see ATS sales jumping 23%.
That makes total sense. Now, there was another really interesting term they threw around in the segment regarding their test and inspection business. They said demand there is starting to inflect. And this involves X-ray machines, right?
Yes, X-rays.
Yeah.
And this connects directly back to our pancake stack analogy.
Okay.
Think about it. Once you glue all those delicate layers together, you can't see the electrical connections anymore. They're completely buried inside the stack.
Right, you can't just eyeball it to see if it worked.
Exactly. You need Superman vision. You need X-rays. For a while, this specific X-ray business for Nordson was kind of flat because it relied heavily on the automotive industry, which has been pretty sluggish.
Sure.
But now, because these AI chip stacks are so impossibly complex and so wildly expensive, manufacturers are inspecting everything. They're buying Nordson's automated X-ray systems to scan every single completed chip stack to ensure what they call yield.
Because you simply cannot afford to ship a broken super chip to a data center.
Exactly. You have to catch the void before it ships.
It's fascinating. The sheer complexity of the problem, the physics of the heat and the 3D stacking is what literally creates the massive market for Nordson's solution.
It is the ultimate pick and shovel play for the AI gold rush. Nordson does not care which AI software model wins the race.
Right, Google, Microsoft, whoever.
It doesn't matter to them. They know that whoever wins is going to need complex, vertically stacked chips, and those chips will require precision dispensing and X-ray inspection.
That's a great position to be in. Now, I do want to pivot to the geography of all this for a second, because their CFO, Dan Hopgood, dropped a statistic on the call that really made me pause. He noted that this surging demand is primarily being driven by the Asia-Pacific region.
It was a very stark contrast in the geographic numbers.
We will get to the exact breakdown a bit later, but just broadly speaking, it seems like the center of gravity for this ultra-high-tech manufacturing is still firmly across the Pacific.
It really is. The advanced packaging capacity, the actual physical factories that do the stacking and gluing we just talked about, they are overwhelmingly located in Asia right now. Korea, Taiwan, China. That is where Nordson's machines are currently being shipped.
We're definitely going to come back to the implications of that at the end of the show.
That sounds good.
But first, we need to look at the other side of the house. Because Nordson isn't purely an AI play. They have two other massive segments: Industrial Precision Solutions, or IPS, and Medical and Fluid Solutions, MFS. These are the traditional workhorses of the company. How are they holding up in this economy?
Let's look at IPS first. This is the heavy industry stuff. We're talking robots that paint cars, machines that seal the cereal boxes we mentioned in the intro.
Yeah.
Sales there were up 9% in total, but the organic growth was only 3%.
Okay, so 3% organic, steady, but certainly not a rocket ship like the semiconductor side.
Exactly. It's stable.
Mm-hmm.
And the story here is all about the mix. Some end markets are working well, some aren't. They specifically highlighted precision agriculture as a bright growth spot, particularly down in South America and over in Europe.
Precision agriculture. What exactly does Nordson do on a farm?
Oh, this is really cool tech.
Yeah.
So historically, a farmer would just broadly spray pesticide or fertilizer over an entire field.
Right.
But Nordson manufactures these incredibly smart, high-speed valves that go on the tractors. They use sensors to actually see the individual plant, and the valve opens for a fraction of a second to spray only the plant, completely missing the dirt.
Wow, that's amazing.
It saves the farmer a massive amount of money on expensive chemicals, and obviously it's way better for the environment. So that part of the business is seeing real growth.
That makes total sense. Efficiency is always in demand, no matter the economy. But what about their heavy hitters in that segment, like automotive and polymer processing?
Management used the word stabilized for those.
Which feels like nice corporate speak for, well, it's stopped getting worse.
That's pretty much exactly what it means. Last year, those sectors were a significant drag on the company's overall performance. Now, they're just flat. Polymer processing is essentially making things out of plastic, right?
Yeah.
And that's very closely tied to consumer spending.
If people aren't buying new patio furniture or plastic appliances, factories don't need new plastic molding machines from Nordson.
Spot on. So the fact that those orders are flat, not falling, but not growing, tells us the broader consumer economy is okay, but it's definitely not booming.
Got it. Now let's talk about the medical segment, MFS. I looked at the top line number there and I actually got a little worried. Sales were totally flat, $193 million, basically unchanged from Q1 of last year. Is the medical tech business stalling out?
It definitely looks that way at first glance, but we have to do that forensic accounting thing again. Remember that divestiture we talked about earlier?
Sure.
They sold off a contract manufacturing business last year. That unit alone removed about 4% of their historical sales volume. If you add that back in to get a true apples-to-apples comparison, organic growth for medical was actually plus 3%.
Okay, that's better. So it is growing, but still, 3% feels a little light for medical tech, doesn't it? Usually, that's a much higher growth, reliable area.
It is a bit of a slow start to the year, but they actually have a very specific excuse for it, and for once, it's a completely valid one. It involves the weather.
The weather, come on.
Seriously, the weather. Think back to late January of this year, 2026. Do you remember that news coverage about the East Coast?
Oh, right. The massive winter storms. It was a mess.
Huge, crippling storms. Well, Nordson has significant manufacturing operations and supply chain routes that run right through the East Coast of the U.S. They literally had to shut down facilities for 2 to 3 days right at the very end of January.
But does closing for 2 days really impact a multi-billion-dollar global company that much?
It absolutely does when it happens on the final 2 days of the financial quarter.
Ah.
In the manufacturing and logistics world, the very end of the quarter is always this mad dash to get finished product out the shipping doors so the accountants can officially recognize the revenue. Losing those final 48 hours of shipping capacity costs them an estimated 1% of their total sales for the entire quarter.
That is wild. A snowstorm in New Jersey literally ripples through the official earnings report of a global industrial giant.
It just shows you how incredibly tight and optimized these modern supply chains are. There is no slack. But looking forward, management is very confident. They noted that the medical market is finally normalizing. All those weird post-COVID inventory fluctuations at the hospitals are settling down, and they fully expect this segment to get back to historical mid-single-digit growth soon.
All right, so we have the AI rocket ship in ATS, the steady industrial workhorse in IPS, and the medical business that basically just needs the snow to melt.
Exactly.
Let's talk about the actual money that ends up in the bank, the profit margins.
EBITDA came in at $203 million, which translates to a 30% margin.
I mean, a 30% margin is incredibly thick for a physical manufacturing company. Usually, building heavy hardware is a much lower margin game.
It is. 30% is bordering on software-level profitability territory. It just goes to show how highly specialized and necessary their equipment is. They clearly have immense pricing power. However, they did warn investors about some slight pressure on margins in the industrial segment due to something they call mix.
We hear the word mix a lot on these earnings calls, negative mix shift. What does that actually mean for the listener in plain English?
It's a pretty simple concept. It essentially asks, what exactly did we sell today? Nordson makes a ton of profit percentage-wise when they sell spare parts here in the U.S. A replacement nozzle or a specialized valve has a massive markup,
Okay.
but they make a lower profit percentage-wise when they sell a massive million-dollar automated system to a brand new factory being built in Asia.
Because building a giant machine from scratch involves huge amounts of steel, labor, ocean shipping, and expensive installation costs.
Exactly. The costs are way higher. And right now, what is driving the entire company's massive growth?
Those giant system sales in Asia for the semiconductor boom.
Precisely.
Yeah.
So they are bringing in a mountain of new revenue dollars, which is fantastic, but the percentage of profit on those specific dollars is slightly lower than their historical average.
It's a high-class problem to have, honestly. Oh no, we're selling too many of our giant expensive machines.
It really is. It drags the overall margin percentage down a tiny bit on a spreadsheet, but you take those absolute millions of dollars to the bank every single time.
And speaking of the bank, looking at this report, this company is an absolute cash machine.
It's impressive. Free cash flow was $123 million for the quarter.
And I saw their cash conversion rate was over 100% of net income. For the listeners who maybe aren't accountants, why is that metric so impressive?
It basically proves that their profit isn't just a theoretical number on an income statement. Sometimes companies report a huge profit, but the actual money is tied up in unsold inventory sitting on a warehouse shelf or in invoices that customers haven't actually paid yet.
Right.
A conversion rate over 100% means that for every single dollar of profit they reported to Wall Street, they actually put a dollar or slightly more of hard, cold cash into their corporate bank account.
And they clearly aren't just sitting on that cash like a dragon guarding its gold.
No, they are aggressively deploying it. In just this one 3-month quarter, they spent $82 million buying back their own stock, and they paid out another $46 million in dividends to shareholders.
That is a very confident move by the board.
Extremely confident. And even after spending all that cash, their balance sheet is pristine. Their debt leverage ratio is only 2.1 times. That gives them plenty of dry powder if they see a smaller company they want to acquire later this year.
So it's a great quarter. They're flush with cash. What are they telling us about the rest of 2026? Because they actually updated their full-year guidance, right?
They raised it, and that is the exact signal every investor loves to see. They bumped up the full-year sales forecast to a new range of $2.86 billion to $2.98 billion, and they raised the earnings forecast to between $11 and $11.60 per share.
But reading the transcript, the CEO, Sundaram Nagarajan, seemed pretty balanced in his comments. He wasn't exactly doing a victory lap.
I would describe his tone as optimistic but highly prudent. He knows the AI demand is completely real. He can clearly see the massive order backlog, but he also knows the broader industrial economy is still a bit fragile. There was a word they used repeatedly regarding the semiconductor systems business that I absolutely love, lumpy.
Lumpy. It really doesn't sound very scientific for a cutting-edge tech field.
It's a great finance word, though. It basically means the growth isn't a smooth, straight line up and to the right. When you are selling million-dollar systems for a massive factory line, you only get to recognize the revenue when the customer is actually ready to physically install it.
Right.
If the customer's factory construction is delayed by a month, your revenue shifts to the next month.
So just because Q1 was up a staggering 23%, it doesn't mean Q2 will be exactly the same.
Right. You might have a flat month followed by an absolute blockbuster month. That's what lumpy means. But the overall multi-year trend line is clearly rocketing upward.
And regarding that raised guidance, they actually explained their internal logic for the high and low ends of the range.
They did, which is helpful. The high end of that $11.60 EPS assumes that the broader industrial and automotive markets improve a little bit throughout the year. The low end assumes they actually pull back and weaken.
So they're hedging their bets publicly.
They're essentially telling Wall Street, look, the AI stuff is real and it's happening right now, but the rest of the economy, we are actively planning for a downside scenario just to be safe. It's a very responsible, mature way to run a financial forecast.
So let's pull this all together. Why should you, the listener, who maybe doesn't care at all about fluid dispensing nozzles or polymer processing machines, care about this specific earnings report?
I think the biggest takeaway here is that the AI boom is officially shifting phases.
How so?
Well, for the last 2 years, it has been almost entirely about software and data centers and NVIDIA designing chips. It's been very digital, very conceptual. But this Nordson report confirms that the boom is now driving massive, tangible, physical infrastructure investment.
It's getting real. It's leaving the cloud and finally hitting the factory floor.
Exactly. It's not just lines of code anymore. It's steel and aluminum and high-tech fluid dispensing systems and automated X-ray machines. You simply cannot have AI without advanced packaging, and you cannot have advanced packaging without companies exactly like Nordson.
It is the physical manifestation of the digital revolution.
Perfectly put. And the fact that Nordson also has this incredibly stable industrial base here, the cereal boxes, the agricultural valves, the medical catheters, it adds a really nice layer of safety. It's a wonderfully hedged bet on the future of manufacturing.
Before we go, I want to leave everyone with one final, slightly provocative thought to chew on. We promised earlier we'd come back to the geography of all this.
Yes. The Asia versus the Americas split.
Right. Let's just look at those Q1 growth numbers one more time. Sales in the Asia-Pacific region were up 25%.
A truly massive jump.
Meanwhile, sales in the Americas, North and South America were actually down 2.2%.
That is a glaring divergence in the data.
Because we constantly hear in the news about the manufacturing renaissance here in the U.S. We hear about the CHIP Act and tens of billions of dollars in government subsidies being poured into building new chip factories in Arizona and Ohio and Texas.
Right, the whole onshoring narrative.
Exactly. We are told we are aggressively onshoring the critical tech supply chain. And yet, when we look at the actual real-time order book of a vital supplier like Nordson, the company that sells the essential equipment to actually make these advanced chips, right now, in early 2026, the real money is still rapidly moving east.
It tells us that there is a massive lag. Or maybe it points to something much more permanent.
How do you mean?
Well, the factory construction in the U.S. is happening, sure. The concrete is being poured. But the immediate, desperate demand for advanced packaging, the actual physical capacity that goes into the AI servers being plugged in today, that capacity is almost entirely in Korea, Taiwan, and China. Nordson goes where the functioning factories are. And right now, the factories actually buying and installing the equipment are in Asia.
It really challenges the political narrative that we can just turn on domestic high-tech manufacturing overnight with a few subsidies.
It proves mathematically that you can't. This is a highly specialized supply chain that has been deeply entrenched in Asia for 30 years. You have the engineering talent there, the localized ecosystems, the raw material suppliers. Economic gravity is incredibly hard to fight. Even with billions in U.S. subsidies, the true center of mass for advanced electronics manufacturing is clearly still across the Pacific.
So the real question you have to ask is, are we seeing a permanent shift? Is the semiconductor packaging supply chain just too complex, too deep, and frankly, too expensive to ever really move back to the Americas, regardless of the politics?
That is the multi-billion-dollar question for the next decade. And if you look at Nordson's shipping labels this exact quarter, the answer seems to be pretty clear. The East is still the engine of the AI hardware boom.
Definitely something to think about the next time you pick up your smartphone and wonder exactly how many layers of silicon pancakes are stacked inside and who exactly glued them together.
And if they manage to avoid any air bubbles...
Let's certainly hope so for the sake of your battery life. That is it for this deep dive on Nordson's Q1 report. Thanks so much for listening, and we'll catch you on the next one.